Hello, everyone. My guest today is Heath Wells. He's the CEO and co-founder of NuORDER, a B2B e-commerce platform that is revolutionizing the wholesale industry. He's an entrepreneur at heart, starting his first internet-based business at the age of 15 in Australia. And then from 04 to 08, he served as managing director at First Media in Australia, where he and partner led the company to great success across publishing, creative, and digital commerce. Heath, are you ready to take us to the top?
Absolutely, mate. Ready to go.
All right, good. So tell us about NuORDER. What's the company do, and is it a SaaS model?
Yeah, it's a SaaS model. So NuORDER is a B2B e-commerce platform. Super simple concept. We essentially take e-commerce and apply it over wholesale. So you have a brand on one side, so let's say Lacoste, and you have a retailer on the other side who's the buyer, and that ranges from Nordstrom, Amazon, all the way to the small mom and pop store.
Okay. And give me a general sense here. I mean, are you charging both sides of the marketplace or one side? How do you make money?
So just one side. So brands pay us a subscription fee ranging from around about $12,500 up to $1 million.
Per month or year?
Yeah, that's per year. So we have three, very separate cohorts. You have your SMBs, then you have your mid-market, and then you have your whales and your enterprise.
Yeah. So I'm going to force you into an average just because we're limited on time and can't cover all three of them. If you looked at an average customer, are they paying what, like $100,000 a year, or what's a good middle spot?
Sub 50, more than 30, probably sub 50. So in that range.
Okay.
We try and look at it. Now that we're a little bit further along, you don't just want to look at averages, but yeah, it's between the $30,000 and $50,000.
Yeah. Again, this is just for the purpose of the podcast. It sounds like you do have three separate cohorts, which is great. So call it 30 to 50 grand is a good kind of middle sector space there. And walk me through kind of the timeline here. When did you launch the company? What year?
We actually launched in late 2011, and full transparency, it's been a bit of a slow burn the first few years, but it's one of those things where you have to wait for the tipping point to occur. And it has literally been the last 12, 18 months that it's just been all action. And when you parallel that to some of the other e-commerce platforms, you look at Demandware, Hybris, on the B2C side, they all went through a similar journey. So I think, we were early, and really the B2B e-commerce market has really just picked up this last 12, 18 months.
Mm-hmm. And what have you scaled to today in terms of total customers?
Yeah, total customers today is 1,000 on the brand side. So really amazing number. And on the retailer side, it's 400,000.
Okay, that's great. But free for them, right? Free for the 400,000.
Correct.
Yep, that's great. And you just raised additional capital. So how much capital to date have you raised?
Yeah, so we just announced a new raise of $15 million in growth capital. So it takes our total raise to close to $40 million. And what's exciting about this most recent raise, although it's our largest raise, it was actually our quickest. It took 90 days from actually first meeting to close. So again, just a proof point that the tipping point is here and people are acknowledging it.
Heath, all operating capital, or is any of that 15 going to early shareholders on a kind of a secondary model?
All operating. We're in this. When everything is kind of unfolding in front of your eyes, it's about game on and really putting it to work on engineering, customer success, international expansion, sales, and marketing.
And how many months of burn will that new 15 cover for you? How much runway did you buy yourself?
So to be honest, we can actually turn cash positive. We're one of these interesting SaaS companies, which in 2016 we actually turned cash positive, and decided to strategically, dip the other way given the market changes and the growth. And so this can actually, we'll only spend half of it and be able to turn cash positive again. Whether that happens or not, let's talk again in 12, 18 months, whether that's still the strategy. But, there's no, we haven't kind of put that out as, hey, it's 2 years of burn. That's not how
I understand you could at any moment go cash flow positive. I get that and I appreciate that. But you wouldn't raise capital unless you knew where to invest, which would put you in the red for a little bit, right? So before this $15 million round, were you back at cash flow positive from prior rounds, or were you still burning?
We were still burning. So in 2016, we were cash positive, and then we've decided to do another small round and went negative again, and that's fueled the growth into this one. So, to call it 2-3 years of burn if you want to really go aggressive.
Okay, got it. So what, you're happy kind of burning from a cash perspective, like, 150 to 250, $1,000 a month, something like that?
Yeah, and we'll push even harder, depending on the opportunities. And so, it's nice to have a war chest there to be able to, go after, interesting, new business opportunities or, as I mentioned, international markets. So We'll push that a little higher.
And what's team size today?
We're approaching 100 people.
All in LA?
No, we got offices in LA, New York, London, and one person in Australia. And so, we're building out, especially New York and London at the moment, but the majority is in LA.
And it sounds like you have good scale today, right? I mean, $30,000 ACV is $2,500 a month across 1,000 customers. That puts you at what, $2.5 million a month in MRR? Is that directionally correct?
No, it's slightly less than that. And the reason is you've got to look at it. You can't just say, well, what's the current ACV, given that there was a tipping point. And so, we do have a couple of customers, when you look at it, you have a couple of customers at the $1 million level, you have some, in the 500,000, and then there's obviously a big portion, in that smaller area. And so, it's definitely double digits, just slightly, less than where you are.
Have you broken the 2 million a month yet?
No.
Will that happen in the near future, you'd say?
Yeah.
Like maybe before the end of the year, you got 10, 20 days left.
No, not before end of year. No, unless something magical happens.
Okay, good. And then help me understand growth. So if you're kind of flirting with that, we'll call it $20 million in ARR today. Where were you about a year ago?
So it's been a really interesting rise where every quarter on quarter just gets more. And as we go into 2019, doubling looks like a very clear shot.
Okay.
And so less than double this year, and we'll do double this next year, which we're really excited about because, when you've got
hold on, before you explain it, let me just make sure I understood that correctly. So you said over the past 12 months, less than doubling. So if you're at $20 million in run rate today, you're saying last year you're at maybe like 10, 11, 12, 13 million, something like that?
Yeah, less than that. Yep.
Sorry, less than what?
I love how you try and get these people. When I listen to your podcast, I love how you try and corral them. But we were less than 10 million last year.
Okay, then that would mean you were more than doubled, not less than double.
No, we haven't doubled yet because we're not at the 20 million mark yet.
I see what you're saying. Okay, got it. That makes more sense. Got it. So less than 10 million run rate a year ago. Where's most of the growth come from? Expanding the 1,000 companies you already have on the platform, or adding new logos? Totally.
No, it's both. And so, but new logos is by far and away the lion's share. So, we really kind of took a prioritization to go after the enterprise. And so adding, big name brands to the roster, and that has really driven the growth. But expansion has been really phenomenal. So I know you're going to ask me about churn and things like that.
You must listen to the show.
Of course, right?
Good. So Heath, make this easy on me. Just give me the numbers you can share.
No, I'm not going to I don't want to make it easy on you because I'm a listener. So that would be we'd lose the game, right?
Yeah. Tell me about the expansion stuff though.
Yeah. So expansion, we're well past in net churn levels. We're well past 110%. We're positive net churn and.
You mean, hold on, just to be clear, 110% net revenue retention annually.
Correct.
Yeah, 100% churn would not be a good thing.
No, that would be terrible. So, where we are is in terms of expansion, it's pretty solid. You could call, 20, 30 something % of our revenues is coming from there, and then the rest is from new business. But the reality is, it's mostly greenfield, and so we're just attacking it as hard as we can in the verticals we are in.
And I'm understanding that right. So if you've got 30% expansion and 110% net, that means you're churning about 20% of your ARR each year.
So it's not 30%. It's not 30% expansion. We're less than that, and we have single digit churn
annually,
so greater than 110% on a net revenue basis.
Yeah. I want to peel back the 110% onion. That's what I'm trying to do here. So on a gross basis, revenue churn is in the single digits. You said.
Single digits.
Okay. Which means, again, you've got to have expansion there of, call it, at least 15, 20%, something like that, right?
Yep.
That's great. When people do churn, why are they churning?
So again, you've got to look at, when you're at our size and scale, you have to look at cohorts. And so the SMBs, there is just a natural attrition rate. They go out of business, they wake up one morning, they decided they're not going to wholesale. So that's something that, you know, it doesn't matter what you do, there is just a natural attrition in those. In the enterprise cohort, we haven't lost a customer this year. Mm-hmm. And so it's just small downgrades. Maybe they're jettisoning a certain division or something like that. And so you got to kind of look at it as the company gets bigger. You can't just look at one segment. You got to kind of look at across the three.
How aggressive are you being in terms of payback period?
Yeah, so let's. Being a listener of the podcast, I hear these payback periods that are 3 months, and then you dig into the sales model, and it's like I just don't even know how that's possible. And so we're sub 12.
You don't know what's possible.
How people are doing 3 month pay periods with field sales reps, full blown marketing. You know, like it just that. So we're pretty diligent about our metrics. You know, when you do a growth round, you have to grow up. And you've got to look at things, you know, with gross margin in there and everything. And so, you know, where we are is sub 12 months on a payback period.
That's great. Okay, good. So you're spending about $1 and you're getting at least $1 in ARR out of that $1 invested. Exactly. That's great. Yeah, I mean, I'll tell you, when people tell me, you know, a 3 month payback, but they have fields, I mean, you know me, I push extremely hard, and you start uncovering all kinds of things they're just not including. Like, you know, rarely do they include a gross margin payback, right? Rarely is there a gross margin LTV. So when you start multiplying the 85 or 80% on the back of that, it starts to make things look a little bit more like they should, right?
Agree. Yep.
Yeah.
And I think, look, it's just based on maturity. You know, the reality is when I started this, you just weren't, you're trying to do everything. And so you're not as dialed in, you don't have a CFO and things like that. And so there's probably reasons.
Yeah. Why, you know, one of the things I look at when people are raising in terms of is who's got the leverage during the raise. And usually the founder has the leverage if one of two things are true. The company's cash flow positive, or the ARR to funding ratio is above 1, meaning ARR is more than what they've raised. So they're doing $20 million in ARR, but they've only raised $15 million. When you just did this $15 million raise, so before that you raised $25 million, but you're sub $25 million in ARR, so you're kind of backward there. How did you make sure you had some leverage so you didn't get diluted like crazy in this last round? Okay,
so a couple of things is that the market is really, really big. So let's call a spade a spade. B2B e-commerce is a huge market that hasn't been tapped yet. And when you look on the B2C side, there's many billion-dollar exits. It's not just one, right? And so there's none of that household name on the B2B side. So the opportunity's there. People had done the research that we were the leading platform. And so when we were doing this, growth was accelerating, but we weren't adding sales rep headcount or doing more marketing. It was just accelerating because the market was moving. And people knew this was going to be a market. It was just a timing issue. And so I think whenever you're in a raise, it's a dance. And the reality was that is definitely one of the points that, you know, people would ask, you know, you raised more than ARR and, you know, how do you think about that? But then when they take a look under our actual financials, you know, we were smart about how we place our bets, and we're not doing silly things with the cash. And so they'd seen it go into a really robust enterprise product. And then you sit back and you go, hang on, that actually makes sense. The investment is worthy.
Interesting. Very good, Heath. Let's wrap up here with the famous 5. Number 1, what's your favorite business book?
So Hard Things, I was going to say that, you know, the Ben Horowitz book, but everyone's saying that on your podcast, so I couldn't do that. So I'm going to say Powerful. Just read it by Patty McCord. I don't know if you've read it. It's, you know, she's the talent person. She was the talent person at Netflix.
Yeah.
It's a really good read.
I have to ask you, Heath, real quick, because I know you listen to the show. People always go, Nathan, how do you get these CEOs to come on? Like, why do they agree to come on the show? So I have to ask, it's better just ask you. You know what you're getting into. Why did you agree to come on?
It's interesting because I hear, you know, some of the, like I think I was listening even on the drive yesterday, the chap from Cabbage.
Yep.
And
Rob.
You know, it was, you know, really interesting to kind of hear how he's sizing up the business. And, you know, you try and take in as many reference points as you can. I think you've got a cross selection of small through to, you know, unicorns like that.
Yeah. No, they're interesting. They just passed $6 billion in loans to SMBs. The economics are very interesting, but it is fintech. It's a much different model than B2B SaaS.
Agree.
Yeah. All right. Very good. Number 2, is there a CEO you're following or studying right now?
Yeah. So again, not going to say the normal Elon Musk and the things like that. I'd like to give you something different. Is that as you get older and I get a bit of gray hair, the reality is you think about what this journey is all about. And someone that I look at to a lot is a guy called Rich Roll. He's a author, ultra athlete, so doing massive Ironmans, and he actually has a podcast as well. But check him out. He's really great about, provides a lot of inspiration to what I do.
Rich Roll. Number 3, what billing tool do you guys use?
Billing tool.
Yep.
We used to use one that I won't name, that I wasn't fond of, and we just moved to NetSuite.
NetSuite. Okay, good. Number 4, how many hours of sleep do you get every night?
Yeah, so sleep is really important. I think when you're younger, you wear it as a badge of honor. The reality is I really try and shoot for between 6 and 7. And I've got a 2-year-old daughter. That's sometimes hard because you're balancing a baby in a business and a baby at home, but the reality is it's between 6 and 7.
That's great. And married?
Yes. Yeah.
Very good. Married, a kiddo, and how old are you, Heath?
38.
38. Last question. What do you wish your 20-year-old self knew?
I think on a business front, hire great leadership early. I think, when you're small and scrappy, you hope people step into things. And I think, that's sometimes the case, but more often than not, try and hire for the future. On a personal front, probably live life with more gratitude. I think that's probably a lesson that all of us can take away, especially in this holiday period.
Guys, there you have it. Live with gratitude, hire smarter, earlier. Founded the company in 2011. NuORDER, again, connecting. Basically, think of it like B2B e-commerce. So Nordstrom's can buy in bulk from many different brands or things like that. They've got about 1,000 customers on the platform today, 400,000 merchants. They're flirting with it. Call it 16, 17, 18 million bucks in terms of ARR, growing at about doubling year over year, spending anywhere between, or burning anywhere between, call it 200 and 250, 300 grand a month as they look to scale. They've just raised another 15 million bucks, so 40 million raised to date. Team of 100 in LA, New York, London, and Australia. 5% revenue churn, or single-digit revenue churn annually, 110% net revenue retention. In terms of CAC aggressiveness, $1 in, $1 out. So 12-month payback, healthy growth. Heath, thanks for taking us to the top.
Good on you. Thanks, Nathan.